From the morning reading, the Dow Jones Industrial has its highest close since July, up almost 200 points. The QQQ makes a record high. The SPY has a bull flag bounce. GoPro earnings missed estimates and are down about 17.4% in after-hours trading. 7 sectors moved higher on Wednesday. XLF, XLE, and XLB were the strongest sectors, while XLU was the weakest sector. Breadth strengthened on the New York Stock Exchange as advancers led decliners 3.74 to 1 on the New York Stock Exchange and 3.71 to 1 on the NASDAQ. Fed's hawkish tone boosts bond yields. That helps banks and insurers, but hurts utilities. Dollar rally hurts gold. Energy stocks rebound with crude oil. S&P 500 hits 2-month high. Small caps achieve bullish breakout. Today's Fed statement had a slightly more hawkish tone than markets were expecting and left the door open for a possible December rate hike. The financials clear the 200-day line. Banks up, utilities down. Banks had a strong day while utilities were sold. That the result of a jump in bond yields. S&P 500 bounces off the 200-day line as small caps turn up. The S&P 500 hitting a new 2-month high after holding support at its 200-day average. It's a good sign when a broken moving average line starts providing support. Some writers had expressed concern about the lack of market breadth during the October rally. That's been due largely to the lagging action in small and mid-cap stocks. That situation has taken a turn for the better. The S&P 600 small cap index, the Russell 2000 small cap, and the S&P 400 mid cap all broke out to 2-month highs. The broadening out of the October rally to small and mid-sized stocks should relieve concerns about this being just a large cap rally. And then I've got a picture for you. This is a heat map, and it's actually the heat map of the Russell 2000. The fact that virtually the entire area of the map is green confirms the market's increasing risk appetite, and with this comes sturdier footing for a continuation higher by the U.S. stock market into year end. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:43 a.m. Central Time, and I'm recording this in preparation for the market day of October the 29th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive in to our morning report. And after such a big day yesterday, not a bit surprising that overnight would bring some weakness. And indeed, the S&Ps are down almost 0.5%. The Russell's down about 1/3%. NASDAQ down over 0.5%. And the Dow down about 0.5%. Crude oil down 1.35%, giving back some of those big gains from yesterday. The euro is scratch. Bonds are down just marginally. I said euro scratch. Euro's actually up about 0.6%. 67 pips, and then the gold is down almost 1.5%. So quite a bit of action really there in the overnight. China up about 1/3%. Hong Kong down about 2/3%. Japan up marginally. So quite mixed in Asia. Europe is weak, with Germany down just about 0.25%. United Kingdom down almost 1%. In terms of macroeconomic reports for today, you have advanced GDP and then the weekly version of unemployment claims. The GDP will be the primary focus. Obviously that number comes out, constantly as they make their various revisions, but still folks will be watching that one pretty closely. Also, you have FOMC member Lockhart speaking during the I guess just before the market opens, and then pending home sales during market hours, as is natural gas. That should take care of that today. Tomorrow, just a peek ahead. Let's see, employment cost index, core price index, personal spending, Chicago PMI, and FOMC member Williams speaking, and then of course the University of Michigan consumer sentiment. So actually for a Friday, there's a full slate of macroeconomic events for tomorrow, so kind of keep that in mind. In terms of our current volatility conditions, short-term VIX down to a 14.57. IV percentiles very low. They've been low here for the last several days, and they continue to be remarkably low. See the 3 standard deviation move that was put in by the Russell, and indeed, you got to look at this. In the last 2 weeks, we've got two standard deviation moves, 1 standard deviation moves, and 3 standard deviation moves in the Russell, and the vast majority of this was bullish. So clearly the Russell is starting to play some catch-up, reversion to the mean activity to its cousins, especially the Nasdaq. Nasdaq has been doing quite well, and so starting to play some catch up there, and that is a very good sign, as you heard from the morning reading. It doesn't necessarily mean that the SPX is going to go down when the Russell doesn't behave, but it certainly means that the bullishness and breadth of the market to be able to have continuation patterns and really run is lacking. You really like to see the Nasdaq and the Russell participating. Also notice that the skew is still relatively high here. We've had this persistent skew. So while people may be buying and the market may be going up, we may even have increasing breadth, there's still an awful lot of hedging activity that's taking place with that, because people are very cautious. And if you think about that, there's good reason. Indeed, I think we're on our 9th confirmed uptrend by IBD status in the year 2015, with the prior 8 all failing. So you could see while people have decided to use more hedging activities, even when things seemingly are becoming quite strong. Indeed, accumulation distribution on the S&P chart is a B+, and the Nasdaq a C, so some improvements on that. GMI index bounced back to a 6 out of 6, though that author still remains in cash. Primary market condition is weak bear, though this situation could very well be changing. I'll have to double check on that one. Decision points charts have not yet changed for the long term in some of these intermediate term signals, so we still remain quite mixed here with all of our short term and half of our intermediate term, bullish in posture, but half the intermediate and all the long term essentially bearish. So when you put all this together with the intermediate term market posture still being very bullish with an upslope sentiment, the overall consensus here is improving bullish conditions, but some remaining warning signs out there. So certainly not all bull all the time quite yet. Though position sizing opinions are both pointed to 100%. So whether you're an active trader using a volatility metric or the portfolio investor position sizing, they're both pointing to 100%. Mentioned the intermediate term market posture is very bullish, and indeed S&P, Dow, Nasdaq all over 95 for that matter, very, very bullish. Russell also has turned back to bullish on the intermediate term, though has yet to go into that very bullish camp with the other 3. Overall hedge warning status remains 0+, which is normal with some elevated risk aspects. But those elevated risk aspects are starting to become less and less apparent. And in fact, I really thought about whether this needed to go to a 0. And I decided to leave it at 0+. To me, a 0 is a full out clean bull market, and we don't have that yet. Indeed, if we take a look at the chart here, you have this situation where, yes, we've come from the bounce off the double bottom area and through the various lines of resistance that we've talked about. But we have at this point gone back into the prior range, and to be a zero, means we're really in a truly long-term bull market, and there's very few risk elements apparent. And until we make new highs, we're just back into the old trading range with a little bit of a breakdown that didn't last in the big scheme of things, especially when you're talking about long-term market trends. Didn't last that long, and really other than 3 days and then several weeks to recover the technical damage, this has been a range-bound market for 2015. So hard to call that a normal, healthy, broad-based bull market yet. So we'll remain with a 0 plus as the most appropriate hedge risk condition. But that being said, this was impressive action here. We had this breakthrough back into the range, gap up, bit of a bull flag going into the FOMC, and then a very bullish candle yesterday, so breaking out of that bull flag pattern. So, you've got to give it to the bulls that we've come a very long way from about 1870 now to 2090 area. So what is that, 220 points 220 points since essentially the end of September. So in a 1 month period, we've gone 220 points pretty much straight up, just little teeny short pauses as we encountered each level of resistance. But other than that, pretty much straight up with great energy and increasing breadth during all that time. And increasing breadth, certainly, as we had from the morning reading, includes the Russell. This was an impressive candle by the Russell yesterday. It's also of note that it finally broke through this resistance area. And how many contact points did we have there? 1, 2, 3, 4. Certainly 4 easy counts, 4 or 5 easy counts. But really, if you look at the bodies here, there was about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 11 contact points just in the most recent action where it had stalled up against this level. Well, yesterday broke through with that 3 standard deviation move and on volume and breadth. So this would seem to be on the move at this point. Next area of resistance, of course, will be its prior FOMC wick action. And obviously, if this were to break out of the Ichimoku cloud, we would have a Chikou breakout, setting up. And all these are signs that the Russell and the small caps, which are the growth oriented, are starting to move. On the other growth oriented index, of course, the Nasdaq has been moving and has already broken out well into the prior range, and frankly is very, very close to the all-time highs. I think this was also mentioned in the morning reading. I think we're about 1% or something like that from the prior all-time highs. So the Nasdaq very much leading, and we like to see the Nasdaq leading. Now, also remember, though, that this leading activity was done by virtue of some really big components having good earnings. Amazon, Google, big part of that. And then, of course, the Dow. We've been talking about how the Dow has been kind of the leader, and again, a small number of components kind of leading the way. But it's actually now, in relative terms, behind the Nasdaq and is in par with the S&P, in that basically back to the middle of the prior range. So we'll like to see actually establishing new all-time highs to be able to talk about a even stronger bull market. But this is still a very impressive run, especially since the end of September, with the bulls pretty much in control for a month now. You've got to give that to them. In terms of the rest of our daily report, you see in terms of the lower base indications of risk factors, it's very, very benign. You do have the S&P with a distribution day count of 4. We go to a warning status on 5. Not there yet. Skew continues to be relatively high, and that would predict that we would have about a 10% chance of a 2 standard deviation move in the next 30 days. And then given the frankly that we've moved up 220 points, it wouldn't be surprising to have a little bit of a washout retracement at some point and shake off some of the weakest hands. In terms of new highs, new lows, at the New York Stock Exchange, you see this over 4 to about almost 4.5 to 1 in terms of the 444 new highs on the stock exchange versus less than 100 new lows. And you see all 5 key intermarket risk aversion indicators are solidly risk on at this point. So really very few warning signs. You got the skew. You have, in terms of market posture, you have several warning signs up here at the top where the decision points and so forth are giving us some red arrows, but it'll take a while to heal all the technical damage that was done with that August breakdown. But there are very few signs left, and really technically the primary thing that's left is for the market to establish new all-time highs, and with that we would basically go to 0 on the hedge status, and there would probably be nothing left in terms of elevated risk conditions. In terms of special opinions, as you would expect with that kind of talk about market posture, it's basically all go on all strategies. If you have a mix of higher beta and lower beta, that certainly is probably a good ideal still. And then also use a mix of out of the money and in the money strikes. I wouldn't be surprised if this doesn't start to look more like 2 to 1 of out of the money versus in the money. And the same thing with the high beta, low beta. Not quite there yet with the change in opinion, but you know, you should start leaning more and more bullish. You should start leaning more aggressive in the setups that you're willing to take. Those more aggressive setups, as always, you know, that you might leg into them, or that you might consider in a covered call strategy, selling a put and then legging into the covered call. You know, those are all postures that you can take to kind of scale into more aggressive positions. But you could start thinking about more aggressive setups given this most recent action. In terms of put selling, we always like to frankly use defined risk positions as opposed to you know, just naked puts. That reduces buying power at the very least, and also prevents you know, exposure to something really, really catastrophic from, you know, putting you out of business, and that's a big deal. From a sector market posture, sector specific, you see transportation still weak. That's a bit of a warning sign. Utilities, of course, with that interest rate exposure, took a bit of a hit. Energy, neutral across all 3, though that's actually an improvement. And you also see retail also showed some improvement. So primary warning areas is transportation and, of course, utilities, which is a very defensive posture sector. You know, took something of a hit yesterday with that decision. And you see wide breadth, other than utilities being down over 1%, almost all the other sectors were up, not just up, but very healthily up. And indeed, again, we start to see this consistency: 1 day, 5 day, 1 month, 3 month, even year to date. Most of these sectors are looking much better at this point, with the exception of, on the year to date, energy, of course, still has a lot of recovery to do, and then utilities, also materials. So those 3 sectors are the ones that have been hit the most, and they've still got more work to do. Other than that, most of these sectors have performed pretty well in the most recent time periods as we scale up across the chart. And let's see here. I think that's enough for today. We've had a lot of content today. Obviously, big day yesterday with the Fed. As always, if you find what you're getting here is helpful to your trading, like us on YouTube. Subscribe to us on YouTube. We like to see those subscription numbers go up. That tells us that we're on to something here in terms of what we put together for you in the morning and provide to you. And we greatly appreciate the acknowledgement of such things by retweeting us to your Twitter followers, to your StockTwit followers, etc. Direct comments can go to support@falconglobaltraders.com. There are opportunities out there for greater education. And go to this website right here to learn more about this course, which will be both live and virtual for those that aren't actually in the Chicago suburb of Schaumburg. Also, of course, from Falcon Global's perspective, opportunities to see how we actually apply our trading principles. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. And we will see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.